On the last trading day, we found a wealthy investor trading at least $18 million on Best Buy stock, ticker symbol BBY. And what's unusual about this trade is that Best Buy reports earnings in a few days on August 29th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish or bearish on Best Buy before earnings, so that we can also decide to buy or sell Best Buy before earnings. Because as we all know, the rich have more access to information, including leaked insider information such as earnings reports, to make better financial decisions. No wonder the rich get richer. And then based on our data analysis, we will show how we are trading Best Buy with an option strategy to reduce our risk in order to increase our profits. Now, without further ado, let's dive into the data as usual. As we can see here on the option time and sales tape, 2,332 option contracts being traded at the same time on August 26 at 11:05 for these August 30 options at the 98 strike calls and the September 6 options at the 90 strike calls and the 80 strike puts. So let's take a deeper look at this trade that happened on August 26. So you can see here for the August 30 options, we know that they traded the 98 strike calls, and there was at least 2,300 contracts. And we can see the volume much greater, and most importantly, the open interest is only 65, meaning those options being traded were clearly opening trades, because it's not possible to close out of the trade if there was only 65 open interest. And when we take a look at the September 6 options, at the 80 strike puts, notice also here a 4,000, and again open interest only 62. So these were also opening trades. And when we take a look at the 90 strike calls, same situation here where the open interest is only 91. So we know that those contracts were clearly opening trades. All three of these options were opening trades. And so that's very important to figure out, because if they were closing out of these trades, then the direction in which they were trading in would not be very accurate anymore. And so we can do a quick calculation of the trade cost now that we know these are opening trades, because we can see here that they sold the 80 strike puts, which means that they are willing to own 100 shares at the $80 share price, selling cash secured puts. So we multiply by 100 shares to get $8,000 of buying power required per contract. And since they sold 2,332 contracts, this trade required at least $18 million. But keep in mind, not all of these unusual trades will be profitable. Even this one might be a loss, because earnings events are very high risk. But as long as we diversify with higher quality stock picks based on this type of data analysis, we can become more profitable in the long term. So if you want more stocks wealthy investors are trading for your portfolio diversification, then go to our website. We'll put a link at the top here where you can gain access to better trades with stronger data and our option strategies to reduce risk while increasing profits. So is this wealthy investor bullish or bearish? Well, we have to analyze the trade in more detail. So let's go to the three options that were being traded. And we can see here at the 90 strike calls, they were buying these and they were selling the 80 strike puts, for the September 6 options. And for the August 30th options, they were selling the 98 strike calls. And so when we analyze this trade, we can see here on the risk profile profit loss graph, as the share price, which is represented on the x-axis here, currently trading at $88, and the profit loss on the y-axis, note the zero break-even line. And so when the purple and blue lines are below this break-even, it is a negative loss. If it is a positive gain, this is profit. And that happens when the share price goes up. So we know that this is a bullish long trade. And we can confirm this with the Greeks. The delta here is a positive delta. If it was a negative delta, it would be a bearish short trade. But since it's positive, we know that this is a bullish long trade. And so based on this analysis, how did we trade Best Buy with options? Well, this is our option strategy. And you can see here for the 98 strike calls, we are selling these calls to open. And for the September 6 options, we are actually going to skip the 80 strike puts and not sell these puts because these require a lot of buying power and it makes it more difficult to use position sizing to manage our risk. And so we did not sell the 80 strike puts. We simply skipped over that and we bought the 90 strike calls. And so when we analyze our trade, we can see here that this is a diagonal strategy. Each of our option strategies costs $258 of debit. And you can see here that as the share price goes up, this becomes profitable because this is also a long bullish trade. And that is why when you take a look at the delta, this is also a positive delta trade. But keep in mind, even though we are going long bullish on Best Buy stock before earnings, this is still a high risk trade. So we are still using position sizing to manage our risk because most of our capital is invested in the trades that we share on our website because those are lower risk and higher probability of profit. So if you want access to those trades, we'll put a link at the top here to our website. Let us know in the comments below. Do you think Best Buy is a buy before earnings or a sell before earnings? As usual, please smash the like button, subscribe if you haven't. Take care and have a wonderful day.